Hi class, it's Jennifer Anderson and we're going to talk about today how to determine cost of goods sold using the FIFO inventory costing assumption. If you recall from our previous lessons, the FIFO method stands for first in, first out. So FIFO is the most closely related to what's actually happening with the flow of goods within the company. The first item purchased by the company is the first item sold to the consumer. So as you can see from this diagram right here, which shows it nicely, the first one in by the purchased by the company is actually the first one sold. So this was one of the earlier items purchased, and it's the first item sold. Okay, in order to demonstrate how to calculate cost of goods sold, we need to have a sample company inventory. So we're going to have beginning inventory of 100 units with a cost of $10 multiplied out of $1,000. Then the company had three more purchases during the period, 200 units at $11 for $2,200 cost, 300 units at $12 for $3,600 cost, 400 units at $13 for $5,200 cost. So, and a very important number in our calculation is cost of goods available for sale. That's the sum of beginning inventory costs plus everything they purchased during the period. Comes to $12,000. So remember this number for the future because we're going to use this in our cost of goods sold calculation. Okay, other important numbers here are the total units available for sale were 1,000. And then we're going to assume that they're using the periodic method. And what that means is they counted inventory at the end of the period and they came up with a count of 450 units. They subtracted that from what they had available for sale and determined that 550 must have sold during the period. Okay, so let's go to our spreadsheet and see how the calculations work for cost of goods sold and ending inventory. Okay, so here's our spreadsheet. And this is the same set of facts that we showed you earlier. So $12,000 is in our total goods available for sale for this sample company. And they have 450 in ending inventory. So in order to determine ending inventory is a two-step process. First was going to be determine ending inventory, and second will be to determine the cost of goods sold. So for ending inventory, using the first in, first out method, the first one's in or the first one's out. So this 550 is going to be coming out at the top here. The last ones in are still going to be here. So this 400 is still going to be here. And those cost the company $13. And we still need 50 more, so $50 of the $300 pool are still going to be there at $12. So if you multiply that out, the 5,200 plus the 600 gives you 5,800 in ending inventory. That is your ending inventory balance, okay? And that comes from the last ones in are still here using the FIFO method, okay? So now to back into cost of goods sold, we take cost of goods available for sale minus ending inventory, which we calculated right here, and that gives you cost of goods sold. So $12,000 is your cost of goods available for sale minus the 5,800 that we calculated here. And you could assume cost of goods sold of 6,200. All right, so you can see that if you set it up like this, it's not that difficult of calculation, and it is kind of fun. And let me just review this real quick. So using the FIFO method, ending inventory was calculated by taking the unit cost of the most recent purchase and working backward until all the units were costed. And with FIFO, the last one purchased by the company were the first ones were the ones left in ending inventory. So the ones at the bottom of the list. And cost of goods sold was calculated using that formula. Okay. So thank you very much. And if you have any questions, please email me or use the discussion board. And I hope that helps you solve some of the homework problems in this chapter. Take care.